Before AI, NFT, and big data were buzzwords in Silicon Valley, one name ruled them all: disruption. Every founder claimed their new startup would disrupt an archaic industry through the power of software and replace it with sleek digital alternatives. Investment banks, venture capital firms, private equity, hedge funds, and even individual investors ate this up, fawning over these multi-billion-dollar opportunities. They lined up in droves to give these companies and founders billions to make sure they were on the rocket ship when these companies eventually shot to the moon. Blue Apron, HelloFresh, Marley Spoon, Dinnerly, and Home Chef are all apparently on board this rocket ship to the moon after they supplant Whole Foods, Kroger's, Trader Joe's, Aldi's, and restaurants. In fact, the opportunity to disrupt them is so ripe. There are 323 meal kit companies butting their heads against the wall trying to do it, and they are increasing at a rate of 10% annually. But if we've learned anything from Uber, Airbnb, Zillow, and Casper, it's that although on paper most ideas sound like no-brainer profitable businesses, they crush and burn in the real world. And when billions are involved, CEOs will go at great lengths to stretch the truth and paint assertions of profitability to keep the delusions going and taps of investor money flowing. Although this episode is centered on HelloFresh, the bigger story is about what it represents. If the largest meal kit company in the world is having trouble maintaining profitability, what does that say for the rest? Also, if HelloFresh becomes a penny stock, it would expose Silicon Valley's pump and dump schemes. In this episode, we'll cover HelloFresh and the strategies it's using to keep up appearances and how far it is in its desperate march to viability. The meal kit business is simple. First, you build an e-commerce platform that sells pre-portioned ingredients and ready-to-eat meals to customers. Second, unlike traditional grocers like Kroger's, Whole Foods, and Trader Joe's who buy perishable groceries in bulk and lose a portion of it because they go bad, you do not have the same problems since you do not buy any inventory of your own. Instead, you only buy inventory once customers have paid for their orders and your work is only to fulfill them. Basically, you just act as a middleman between farmers and your customers. With over 28 million orders, you achieve economies of scale similar to those of Kroger's, Whole Foods, Aldi's, and Trader Joe's, meaning you can also negotiate for the same prices they get from farmers. And, while these old-school grocers have massive fixed costs in rent, you do not. Instead, your only fixed overhead is in fulfillment warehouses since your platform acts as an online grocer and can serve all 300 million Americans. On the demand side, you have a total addressable market of $184 billion and growing fast. Also, when it comes to their food budget, your customers' largest share of their wallet goes to dinner, and this coupled with the fact that consumers nowadays value convenience and healthy eating makes meal kits the perfect solution. Meal kits are more convenient, less tedious, healthy, and customers can experiment with different recipes and cuisines. By now, you are probably convinced that this is the next Uber, and like me, you can finally stop regretting not buying Bitcoin or Apple stock early. So you log into your Robinhood account and hit that buy button. However, like in most things, the devil is in the details. It's not just about flashy business models, but the numbers which tell the real story. In 2020, HelloFresh's revenue soared from 1.8 billion to 3.7 billion euros. This sudden surge in revenue was driven by a spike in home-cooked meals as people stayed in during the pandemic. COVID single-handedly propelled HelloFresh into profitability with an operational profit of 426 million euros that year. However, since then, HelloFresh's fortunes have waned. Their profit has been on a consistent decline, dropping to just 112 million euros in 2023. Unsurprisingly, this downward trajectory is mirrored in their stock price, which has plummeted from a peak of 90 euros per share to now 7 euros per share. But this raises a crucial question: why the dramatic drop in profitability? After all, according to Dominik Richter, HelloFresh's founder and CEO, the surge in customer engagement during the pandemic wasn't a fleeting trend. Instead, it marked a transitionary period where customers would now allocate more of their budgets to home meal kit solutions, and they were now choosing to buy groceries and food based on product fit rather than proximity to their nearest Kroger's.
In addition, e-commerce adoption has also been pulled forward in a very short amount of time. What would have taken usually 3 years happened in 3 months and with very little customer acquisition cost.
To unravel the mystery behind HelloFresh's plummeting profits, we have to scrutinize their marketing expenses. During the peak of the lockdown, order volumes from their existing subscribers were so high they had no capacity for new customers. As a result, They paused their marketing ads for several weeks or even months. This was just the beginning of their unexpected boon. At the time, digital advertising rates plummeted as companies tightened their belts and scaled back their marketing budgets, making advertising extremely cheap. HelloFresh capitalized on this and spent just 13% of their revenue, down from their usual 20%. This 7% difference reflected positively on their bottom line. However, as things started going back to normal, HelloFresh lost most of the 50 million new customers they had acquired during the pandemic, and they are now at a measly 7 million active customers. Yet Edward Boyes, HelloFresh's chief marketing officer, insists this is all part of their grand strategy. According to him, running a direct-to-consumer model has several benefits over how traditional grocers spend their advertising money. While HelloFresh has to spend a fortune to acquire their first transaction with a customer, all other transactions afterwards come with very little marketing spend. As an online platform, HelloFresh also have data on every customer, which allows them to serve better ads since they know what someone wants, when they want it, and the type of ad creative that would convert them. Like all tech companies nowadays, HelloFresh also claims it uses AI and machine learning models to optimize their ad bidding on platforms like Facebook and Google and enhance their retargeting efforts. Their AI models apparently lets them know how aggressively they should pursue a customer, which products to use to re-engage customers, and which ads will be effective. He argues this enables them to grow their customer base more efficiently than competitors. And the high acquisition costs they are experiencing now are only a result of them going for high-value customers who will make more orders and spend more on each order they make. However, his presentation conveniently lacked supporting charts. For instance, while HelloFresh spent 17% of their revenue on ad spend, Kroger's spent a paltry 0.7%. Moreover, compared to Blue Apron, HelloFresh's AI-driven marketing edge is hard to see. Even more damning is the rate at which HelloFresh loses the customers it spent so much to acquire. In 2022 alone, HelloFresh and its competitors lost over 80% of their acquired subscribers. As a cope, Boyes argues that these lost subscribers are easier to sign up because they are already familiar with HelloFresh's value, and they can always be retargeted to support new brands like Good Chop and Pet's Table. On the other hand, Dominic insists that customer churn rates do not represent their business model. His logic is HelloFresh is not a subscription company, but rather an e-commerce business where customers just have different usage patterns. There are customers who just try their products once and move on once they realize it doesn't fit their lifestyle. There are those who are seasonal users and subscribe intermittently after a few months, and there are customers who fall into a monthly cadence and order weekly. While all this is true, HelloFresh still remains a subscription-based business afflicted by high churn rates, and for customers to make weekly orders, they have to remain subscribed. To hide this harsh reality, HelloFresh announced they would stop posting their number of active customers from 2024 and instead use revenue retention. Yet, even when we use their preferred metric, the reality does not change. They are still losing revenue from lost subscribers. It's an oxymoron to expect more revenue while still experiencing the same churn rates. With these revelations, it's clear that the facade is crumbling, and Dominic Richter is now spinning the narrative that based on recent all-time highs in contribution margins, HelloFresh is well on its way to increasing its profitability. The disclaimer that HelloFresh conveniently hides is that contribution margin is a non-GAAP metric that does not follow established accounting standards. It's a metric that HelloFresh created itself. HelloFresh defines contribution margin as net income excluding marketing expenses and general and administrative expenses. These exclusions inflate HelloFresh's profits by billions, creating a rosier picture for shareholders. For example, in 2023, HelloFresh reported a modest profit of only 112 million euros. But when contribution margins are applied, that figure suddenly transforms into an impressive 2 billion euros. For the investor savvy enough not to be duped by contribution margins, HelloFresh also touts AEBITDA, another self-invented metric that excludes various special costs to look more profitable. In 2023, HelloFresh posted an AEBITDA profit of 447 million euros. It should therefore be no surprise that it is contribution margin and AEBITDA that HelloFresh promotes to investors and the media. Yet, despite these efforts, some investors still remain skeptical about HelloFresh's long-term viability, especially after Blue Apron's collapse sent shockwaves through the meal kit industry. But like any skilled CEO, Dominic Richter is spinning tales that would make even J.K. Rowling envious.
And we still do believe that there is a great opportunity to continue to grow our meal kit penetration in existing markets and new geographies over time. Back in the day, when we pioneered meal kits, we really were looking at this massive food at home TAM and came up with a pretty innovative solution to one of the most frequently asked questions in every household, which is, what's for dinner tonight? But the vision over the last 11 years has become much, much broader. And it reached today, we want to build the world's leading fully integrated food solutions group.
If we strip away the buzzwords, Dominic's core argument is clear. HelloFresh must continue scaling to capture their massive total addressable market and reverse their declining profits. To achieve this, HelloFresh has embarked on a series of ambitious strategies that will magically improve their profits. First, they had to eliminate all competition either through acquisitions or outpricing them. In 2018, they acquired Green Chef and launched Every Plate, a budget-friendly option offering meal kits at $5 to $6 aimed at significantly expanding their customer base. Next on their agenda was improving their menu by adding more menu items and making them more customizable. If you didn't eat pork but one of the pork dishes looks really good, you can just swap it out for chicken or salmon. They also expanded into new segments and started selling breakfast, lunch, snacks, and desserts, and launched new brands like Good Chop, which sells premium meat. They also launched Pet's Table, an offering for pet owners. The logic behind these moves was simple. If HelloFresh could just monetize its shrinking customer base more effectively, by increasing order rates and how much their customers spend per order, they could offset the decline in subscribers. After all, customers now had more reasons to order more than just dinner meal kits. HelloFresh has indeed managed to increase the amount subscribers spend per order, but Dominic conveniently overlooks a key detail. These higher order values were largely driven by their price hikes in 2022 due to inflationary pressures. What's more, he sidesteps the fact that HelloFresh already dominates the meal kit space with a 75% market share in America and a 66% share in Europe, essentially making them a monopoly in two of the most lucrative markets. If you can't turn a profit while controlling such a huge swathe of the market, when will you? And then there's the question of scale. If their entire strategy for increasing profits hinges on achieving higher economies of scale by selling more meals across different segments, when will they do it when they already serve more than 240 million meals annually and make over $7.5 billion in revenue? Dominic believes the answer lies in their ready-to-eat segment.
Let's come to ready-to-eat, which is one of the biggest growth drivers for the next couple of years, and something that has really been a remarkable success story since we've started becoming active in that space about 2.5 years ago. Ready-to-eat is really sort of like after meal kits, the next frontier in direct-to-consumer food solutions, and has a TAM that, in our view, is on par with meal kits. The growth curve that this vertical is going through is very much reminiscent of where meal kits were trading in 2016, 2017, when they really started taking off in a lot of our advanced markets, such as in North America.
HelloFresh's first foray into the ready-to-eat market was in 2018 with the launch of Go Ready. However, it failed due to the difficulty of producing ready-made meals at scale. Instead, they bought Factor for $277 million since Factor already had the operational capacity they needed. According to Dominic, this was a steal since Factor has a strong defensive moats that make their 66% lead in the RTE market unassailable. These include two of the largest industrial kitchens in America and, as part of the HelloFresh group, access to their superior logistics and fulfillment expertise and scale. And according to Dominic, Factor simply just sells the best food. While Dominic's belief in his product is clearly evident, the other two moats are more strategic spins meant to hoodwink weary investors. For starters, Dominic tries to position ready-to-eat meals in an entirely different category of D2C foods, while the reality on the ground is Factor competes with every restaurant and fast food chain that does home deliveries. Furthermore, the existence of Uber Eats, DoorDash, and Grubhub completely undercuts the idea that Factor has a logistical advantage since customers can now get into any of these platforms and buy from thousands of restaurants selling ready-to-eat meals. The claim that Factor could achieve an EBITDA margin of over 10% is easier said than done, especially in an industry known for its slim margins. Running a restaurant is notoriously challenging, with upscale casual dining chains like the Cheesecake Factory operating at just a 9% margin, and steakhouses like Fogo de Chao and Ruth's Chris hovering around 6% and 11% respectively. The irony is that while meal kits might appear to be on the cutting edge of innovation, their business model has been tried and tested before. Perhaps the most popular example is Webvan, a cautionary tale of the excesses of the dot-com bubble. Unsurprisingly, it shares a number of parallels with meal kit companies. Webvan was an online grocery delivery business where customers could order groceries and have them delivered to their doorsteps at their preferred times. Just like HelloFresh and Blue Apron, Webvan was funded by VC firms like SoftBank and Sequoia Capital to the tune of $396 million. Flash with VC cash, Webvan invested heavily in its warehouse and fulfillment infrastructure, spending $1 billion on warehouses and a fleet of delivery trucks. Soon after, it went public in 1999 and raised $375 million during its IPO, despite only having made $395,000 in revenue and $50 million in losses. In contrast, HelloFresh reported revenues of €597 million and an operating loss of €90.5 million before it went public in 2017. Webvan's IPO gave it a valuation of $4.8 billion compared to HelloFresh's valuation of €1.7 billion, and like HelloFresh, Webvan blitzed its way into new markets after their cash injection, aggressively pursuing market share and even acquiring its largest competitor, Homegrocer, for $1.2 billion in stock. This is the same playbook followed by HelloFresh when it acquired Green Chef and Factor. Sadly, a year and a half after Webvan's IPO, its shares were trading at only 6 cents, and Blue Apron received a warning from the New York Stock Exchange since its stock had been trading for less than $1 for more than 30 consecutive days. Although HelloFresh has yet to hit these lows, its story is still ongoing, and I am not optimistic. However, if you still believe the meal kit business is viable, please feel free to comment and subscribe. I am genuinely curious to read your arguments.